Today we learn about income statement, performance, profitability analysis. What is income statement? Income statement or profit and loss account is a financial document that summarizes a company's revenues, expenses, and profit over a given period. The key profitability ratios. This is the definition and the formula. There is four things you must know about a key profitability ratios. The first is a gross margin. Second, operating margin. Third, net margin. And the last, ROA. When and why use profitability ratios? Profitability ratios are essential tools for stakeholders at every level. They transform raw financial data into actionable insights about a company's ability to generate profit relative to its revenue, asset, or equity. This is a theoretical example to calculating the ratios. You see in the slide, the company Alpha Corp in 2023 have a gross margin 40%, have an operating margin 16%, have a net margin 10%, and have an ROE 20%. This is a kind of visualizing the theoretical results. Interpreting the results, Alpha Corps retain 40 cents of every euro after production costs. After our expense, cent 10 cents remain as net profit. The 20% ROE indicates its strong capital efficiency. Shareholder earn 0 that 20 euros, the 20 cents, 0 euro 20 cents for every 1 euro invests. That means a net margin of 10% is considered healthy in most industries. Food benchmarks vary by sector. This is a real-life example. A local bakery. The Boulanger Depot, a small bakery with an annual revenue of 200,000 euro, flour, yeast and ingredient costs 80,000 euros, COGS, a rent, a salary and utility totals 90,000 euro after tax. Net profit is $20,000. Despite high gross margin, operating costs significantly reduce finally profitability, a classic challenge for small business. Comparing industries context matter. Why benchmark vary? A 10% net margin is excellent in retail but below average in software. Always compare ratios within the same industry and again historical performance. This is the expert tips. How to maximize the value of your profitability analysis. First, analyze trends, not snapshot. Combining multiple ratios, benchmark against competitors, drill into line items. This is a key takeaway. Know your statements, master the formulas, track over time, apply expert principle. Profitability ratios are not just a number, they are the language of a business performance. Learn to speak it fluently. Thank you everyone. That's it for today. If you have a question, don't hesitate to put it in the comment and click the bell to notify in a new videos, likes to our videos. Thank you